we have Keith, and Noah's actually still studying, but Keith is actually live with us, and also Anna, both brand new agents that are live. This is,
Nice to be here.
I'm kind of see everybody's name on here. And I think I saw both of you guys in Ignite, or at least saw Anna in Ignite yesterday. I don't know if Keith made it to Ignite.
Yes, I was virtual.
Yep, okay. I had to leave a little bit early. I had an appointment with another agent yesterday afternoon, so I didn't get to stay as long as I normally do. So does anybody, before we really super get going, anybody have anything they want to go over or talk about? Always quiet. How about you, Josh? Do you have anything that you want to?
Well, I was just hoping to help be a resource with any questions that anybody might have, as they've been out there more now doing open houses and working with more buyers and stuff. Any questions and stuff that may have that may have come up or maybe percolating, I'd be happy to answer any of those. I talked a little bit about our jumbo products this morning. Keith had some really good questions on that in that arena. But I could talk people to death about mortgage. So I'm a lot of fun around the dinner table. But but I find sometimes if people have more specific questions, that tends to get to the root of, sort of what things are out there that people are hearing that maybe they need, some help on, or, even if somebody's got a deal that they're working on now and they've got questions about, sort of what's going on with, they've got lending questions or not, maybe getting a lot of communication on, I'm happy to answer those, questions as well.
Josh, I've got a quick overarching question. You give us these tidbits on like jumbo loans every single week, or like a different aspect of the different loans that are available. Is there any area where we can go kind of like study all the different types of loans that you kind of offer?
Yeah, I got to unmute myself there. So yeah, so I can provide you, I can send you guys, and I'll make a note here to send you a sort of a product summary list, and I can include some details on each list, and I think that might help. Obviously we do we do all your common ones. You got your conventional, your FHA, VA, USDA, stuff like that. So, but we do these, sort of specialized jumbos as well. We have, things like, some bridge loan options, so on and so forth. So, so yeah, I'd be happy to put together, sort of a little bit more comprehensive product guide, and I can send it to you. I can send it to Chantel. Maybe she could just send it to the whole group.
Yeah.
And do it that way. And then I won't provide all of the details on them, just because it's just, there's just so much to each different type of product, with underwriting guidelines. But I can provide sort of the summary of sort of each, option. And then if you have questions, and just give me a call. I'm happy to, talk through it.
Great, thank you.
Did you have anything specific, Ryan, that that was sort of interest?
No, not necessarily. It's more of just, I've got multiple different types of buyers, and they have multiple different types of qualifications. So I'd like to be more focused on what is available to them prior to me sending them to you, so that I am informed when I'm discussing it with them.
Sure, absolutely. Okay, great. Yeah.
You have a lot of like zero down loan programs too, USDA and grant programs and things for people that don't have money down or things.
Yeah, we've got a great zero down program right now that allows you to go up to $438,000 on on a purchase price, and that's based on a conventional loan. And I'll make sure to include that in there as well. I think I'd shared that at one point, but there were some updates. The loan limit was pretty low at one point, and we just recently increased it to the 438. So I'll send out some additional details on that as well. But that's a great new option. I've got somebody pre-approved on that right now. That's looking. So absolutely.
What kind of qualification do they need? What kind of credit score and things like that are they?
So minimum is 680 for the credit score on that, and their debt to income ratio needs to stay below 43% for total debt to income, and they need to be a first-time home buyer. Is sort of the primary, drivers of that one. It allows for 0 down and up to 3% in seller contribution towards like closing costs. So, but what I've found with this product is it's been good for folks that were, they've got decent credit. They have maybe like a 3% down payment, but instead of using that 3% towards the down payment, they're looking at doing this program so that they can cover their own closing costs instead of putting that towards because the 3% down doesn't change your payment all that much from going 0 down. And so instead of doing 3% down and asking for seller credit, which isn't necessarily super popular right now in this market, they're able to, they can do the 0 down option and cover their own closing costs with those funds that they have set aside. There's no mortgage insurance on this product, which is nice. The rate's higher. It sort of makes up for the mortgage insurance, but I penciled out one recently, this one that I've got this person pre-approved on, and doing 0 down for the same purchase price versus the 3% down option with mortgage insurance. The 0 down option actually ended up having a lower payment even with a higher rate because of no MI. So, it just sort of comes down to the different scenarios and math of it.
How much higher is the rate?
This one was at 3.875.
That's not bad.
Yeah.
And Josh, I have a question about how how first-time home buyer is defined. Isn't there usually like a 10-year?
I'm sorry, I can't hear you.
Here, hold on.
Okay, is this better?
Yeah, there you go. Okay.
Okay, all right. Yeah, sometimes my headset doesn't work too well. So this question has to do with how you define first-time home buyer. Is it like within the last 10 years, or is it literally never owned a
3
primary
years.
residence? Okay, it's 3. Thank you.
So as long as they have not had ownership in the last 3 years, then they're considered a first-time home buyer.
Okay, thank you.
Wow, that's a good plan.
Mm-hmm.
So that could really help in open houses or with people that are saying, I need to save money. That was actually one of the things on my list today was overcoming objections.
Mm-hmm.
People that are saying, no, I'm going to wait to buy for a few more years till I save some money up. If they wait a few years to buy, they're buying in tomorrow's market, where they could have a product like this where they could buy in today's market and then be gaining equity for a nicer house down the road and then they're not missing out on $50,000 worth of equity that if they would have bought today versus next time.
Right. Yeah. Rates are on the rise right now, and they're going to continue, going up, this trend. So hopefully, they don't go up, too much, but we anticipate we're still going to see, to continue to see a steady rise on them. Inflation, because the Fed has allowed for inflation to continue to start, going a little bit more. With that, mortgage bonds don't like inflation, and so you'll see rates continue to go up a little bit.
So that could become a really, really good rate even 6 months from now.
Absolutely. So if you've got somebody saying they want to wait because they want to save a little bit more money, then whatever they save, they may just be using, for a higher payment at that point because the rate might be higher. So
Qualify
yeah.
for less home if they wait also. I mean, all the way around, they're paying more, they're qualifying for less.
Yep.
It's kind of,
Absolutely.
if
Absolutely.
agents wanted to advertise this loan product and like target first-time home buyers, can you help them with any kind of like a flyer or something? Maybe they can do their
Yeah.
you on one side and you on the other side with this.
Yeah, absolutely. I've put this together and co-branded it with a few of your guys' agents there already. And it's real simple. Just email me your headshot, your preferred branding, if you have anything separate from the KWPP branding. If not, we just use that as fine. And we've already got that on file, but preferred headshot and contact information. And absolutely, we can.
Can it go into a Facebook ad?
Yep, you can we can put it on a PDF for a flyer or, an image that you can use for doing a Facebook ad. Absolutely.
Okay. Then I'll send you my, what do you need exactly? You said headshot and what else?
Yeah, preferred headshot and preferred contact information.
I'm sorry, my phone went off. Headshot and what else? God.
Contact information. So
Okay.
preferred, whatever you want on that flyer or ad. Yeah, for your contact info. So, absolutely.
Okay. I'll zoom it on over.
All right, perfect. Thanks, Stacy.
Cool.
Yeah.
Ashley, did you have some questions?
Yeah, thank you. I think we're all dealing with struggles trying to get listings, and kind of a common opposition I have right now is just that fear of, what if we don't find a home in time? So I'm wondering if you have any other marketing collateral we can share on creative solutions. I know we talked a little bit about bridge loans.
Mm-hmm.
I'm a little uncertain about how to advise in that. So I don't know if you could speak to kind of the good, the bad, and the ugly of that.
Sure. I mean, and I'm sure Chantel can share a little bit more on this as well, but the bridge loan options are, helpful for folks. We did talk about that a little bit, but you've got a couple different options. You've got one that collateralizes both the departing property and the new property. And then you've got one that's just on the departing property. If somebody's got a lot of equity, then the one that just leverages the departing property, maybe a better option. Or if somebody's got the assets to, buy the new home with maybe a little bit less down, then they should be able to, they could buy the new house, and then once they sell their departing property, pay down the new loan and recast it. And so that way they're, in a sense, bridging that purchase. So that's sort of the function of three different options for bridge lending. Another one is Rentback. And Chantel could probably help, talk a little bit more about that, but I guess that might be a little bit more risky. But if somebody sells, and, I've seen a lot of buyers recently being a lot more, willing to give sellers, their 60-day rent back, even at no cost sometimes, to help win that offer. That allowing that seller more flexibility to buy their next place. So that is a real option on the rent back side. Chantel, have you seen more of that?
I have seen, there's a couple of things they could do when they list the property. They could put in there that any sale is contingent on the seller finding replacement property. That one's kind of risky, but somebody, almost like a backup offer kind of a thing, where it could fall apart if the seller doesn't find a new property within that time frame. And then the buyer could walk if they want to, or they could renegotiate at that point for an extended period of time, trying to allow the seller. So you could have a really long escrow in that case. You would put that in your listing. And then the other side of it is the rent back, that you can rent back for up to 2 months. Lending has rules behind that. I think you can only go 60 days usually, sometimes 90 on some loans, I think.
Yeah, so for our primary residence, if they're buying it as a primary residence, then technically it needs to be 60 days for occupancy. You know, and what occupancy means is that at that point, within 60 days, the new buyers need to have the, you know, the utilities and stuff switched over to their name to show, you know, to prove, you know, that's their house now, essentially. So if somebody works out something else and needs more time after that, then that's between the buyers and the, you know, and that seller. But to satisfy lending requirements, it's got to be, you know, 60 days.
So just,
On the-
I'm gonna double down on that one. So just to clarify, again, all they need to do is transfer utilities, but we can be even more clever on the back end for further rent backs or anything like that. It's just basically utilities need to be signed over to the new buyer.
So yeah, so the utilities need to be over there to prove, you know, to prove residency. I mean, the trunk monkey's probably not going to jump out of the back of the car and, you know, and go check. There have been times where there have been audits that have been done. It's rare, but for the most part, you know, for lending guidelines, if somebody's buying as their primary residence, 60-day occupancy. You know, if you know, if there's a change of circumstances later that, you know, somebody needs more time, then that, you know, would need to be worked out. Would need to be worked out there.
Obviously, I wouldn't have made this video if I didn't have actual tips to help you. So I'm gonna get right to those tips. But just real quick, if you're looking for a different.
I'm not sure what that was.
Oh, I think it just wasn't on mute. So.
Yeah. And Josh, are the rates on the bridge loans, you know, higher, or are they the same as today's rates?
So it depends on the option. So if you're just doing the option where you're putting less down and you're doing a conventional loan, then you should be, you know, then your rates can be pretty much the same as what you would get on a, you know, on a 20% down conventional loan. You know, if you do a cross collateral loan, then the rates are generally going to be probably, I don't know, a quarter, probably about a quarter higher to what you might see. That being a portfolio product, the rates don't show, they don't move as much as you see on conventional lending. And so I've seen occasionally where that rate is lower than what you would get on conventional, just because it doesn't move with the market as quite as much, but it does. So, you know, typically we've seen it about a quarter point higher than what you've seen on that. Now on the bridge loan that just leverages the departing property, that's essentially a line of credit. It functions just like a HELOC, but its purpose is for a home equity line of credit. Its purpose is for, you know, bridge lending on a departing home. And so that rate's going to be fine, but it's going to be variable also. So it's not fixed. And so it's going to be higher, probably about a point, you know, maybe a point and a half higher than what you would get. But again, it's something that you're going to keep maybe for 2-3 months. So, so that one's a little bit higher.
Josh, I don't. Oh,
sorry. Go ahead.
All right, my apologies. So, Josh, with those bridge loans, what are, like, I don't know if I missed this, but what are like the top 1 or 2 or 3 uses that a seller will use that bridge loan for? Is it like if they can't rent back and they don't have a property yet secured, they could use those loan proceeds to rent something? Or, I mean, what are some of the, I'll leave it open-ended. What do you usually see?
So the biggest purpose for the bridge loans, depending on which option you go with, is to, you know, essentially provide you a couple things. So one is convenience, right? So you don't have to sell before you buy. And where we see a lot of these, and where a lot of these originally stemmed from, is your, you know, empty nesters, or your, you know, folks downsizing from their big house down to, their retirement house, whatever the case may be. They got a lot of equity in their home, but maybe they've got a lot of stuff in their home also, and they need to really sort of get out of there to clean it up, to get it ready to sell. They just don't want the hassle of, being burdened with having to sell first. And these products provide the convenience of allowing them to, buy, get moved in, and then, clean out the old house, and get, and then sell. So there's a huge convenience factor in it. And again, it's popular with folks that are downsizing a bit. One of the other huge benefits is, in a market like this, it makes you more competitive. So if somebody is buying contingent, and they want to be more competitive, then a bridge loan option could make them non-competitive, or make them more competitive, because they can go non-contingent, versus having to sell first. So those are sort of the two biggest benefits to them. Depending on which option you go with, there's a different, sort of time frame. So like the cross collateral option that allows you to collateralize both the departing and the new home option is going to take about 45 days to close. Okay. And the bridge loan that just leverages the departing property, that one is about a 30-day close. But the nice thing about that one is, if somebody knows that they want to utilize that product, then they can get that done in advance. They can get the bridge loan put into place, and then like I said, it's a line of credit. And so it can just sit there until they get a house under contract. And at that point, they can basically close, whenever, because, if they're using it to purchase the full amount of the new property. If they're just using it for their down payment and closing costs, then it would still be looking at like a 30-day close for their, for their regular lending process to go through. So depends on the situation, but those are really sort of the biggest benefits of that.
Okay.
Do you have to qualify for both houses then? If you are just using your equity for the down and the closing costs, you have to be able to qualify for both at the same time?
Yes. So for that last one, yeah, you've got to qualify to carry, any and all of the loans, the new one plus the departing one. But on the bridge loan, that's the line of credit. The minimum required payments only is interest only, and so the payment requirement isn't quite as hefty. So yeah.
Is the debt to income ratio different?
On that one, I want to say it's like 45%. Yeah, I believe it's 45%. But I would have to double check that one for sure. So, and then the cross collateral one, though, the one that collateralizes both your departing property and the new property, no, you don't have to debt to income qualify for carrying both. You're only really having to debt to income qualify for your for the final loan amount. So say you plan to pay that one down to 200,000, then really only have to qualify is for the $200,000 loan, not the bigger loan, say 500,000. You have to qualify to show that you have enough reserves, enough money in the bank to make the larger payment during the period by which might take you to sell your house. So maybe a 3 to 6 month reserve requirement.
That's good. Any other questions for anybody? Nope.
I have a question I think I know the answer to, but I'll ask Josh while we have him.
Sure. I think we lost you there, Ashley.
Oh, hello.
There we go.
Right, there we go. Sorry. I know I've chatted with you a bit about a few clients that are looking at VA loans. So one of mine obviously is a fiance situation. I think you've answered that they can't qualify until they're married. The other one is a brother and sister. I don't know if there's a difference since they're, direct relatives, if they could both be on the loan, if the brother's a vet, or if he would have to qualify on his own.
Is the sister also a vet?
No.
Okay. Then no. So she can't be on the loan. Well, so let me take that back. She can, but it wouldn't be a zero down circumstance at that point. So the way the VA loan works is you can have a joint loan and you can still go zero down as long as both, to where they're not married, as long as they're both veterans. And you would essentially be using 50% of each veteran's benefit to qualify for that loan. So if brother and sister were both vets, then yes, they could still do it at zero down. Now you can do a joint application on a VA loan where somebody is where they're not married. It's just not really advantageous to do so because you can't go zero down anymore. Basically, what the VA says is, okay, since you have a joint loan, then we're only going to guarantee 50% of this loan, and we're going to require that the other owner brings in 25% of their half of that home. So at that point, the down payment requirement is, higher than what you would have for, FHA or conventional. So it's, you rarely see those circumstances. So you don't really see that very often.
Could they qualify on just in the situation, the brothers' finances? And is there an option to add the sister's name later? I mean, she's trying to help build her credit, I guess, is kind of, she wants to have some ownership.
He could probably add her to title later, but it wouldn't help her with her credit because she wouldn't be added to the loan. So yeah, unfortunately, no, wouldn't be able to add her to the loan.
Can't she do, to build credit, can't she do what the guy that fixes credit that told us about before, where she can be a signer on one of his credit cards?
Yeah, so absolutely. For building credit, the best option is to,
That's what I did for both my kids.
Yeah, no, absolutely. So she could get added to to an existing credit card as an authorized user. As long as the card is in good standing, it's got good history, it's utilized, it's underutilized, then that's a great option. Additionally, she could get a secured credit card. So Citibank's got a good secured credit card. I think Capital One has a good secured credit card. And it really doesn't matter what the limit is on those. They could be as low as $300. It's going to report to the credit bureau the same, as long as they are underutilizing it. So they want to keep it, they don't want to be carrying a balance more than like 15%, 10 to 15% on it. And after a few months, that's going to really help boost their credit. So installment debt, it's nice to have that bucket for somebody on their credit bureau, but really the revolving debt credit lines, that's going to have the biggest impact and going to build credit quickest, as long as it's being underutilized. It's also the quickest way to ruin your credit. So sort of a double-edged sword. So as long as you are, keeping it underutilized, payments up to date, stuff like that, then it's a great tool to help build your credit. Absolutely.
I've heard that if you charge more than 30% on your credit card, that drags your credit score down also. I don't know. Is that true?
Yeah, I mean, especially once you get over 50% is really when it starts doing more damage. So once you go over the 30% mark, it's, it's maybe a little bit more neutral, I guess. But once you start hitting that 50% and higher mark, then that's when it could, and that's per account. It's not an aggregate amount. So that's per account, per line. So yeah, you definitely want to, you know, try to keep it under 30% utilized. Which seems silly because why do they give you this limit if you're not allowed to use it? But that's the game that the credit bureaus play apparently. So yeah,
I've seen it make a 50-point difference, 50 or 70. I mean, it can make a gigantic difference to be going over that.
yeah, absolutely, absolutely. So, and then actually, if your client wants to talk with the credit repair folks that I have, they'll do like a free initial consultation with her, and sort of take a look at her situation, and if it's something that she wants to do, sign up for, then great. If not, that's fine too. But I've seen these guys really help a lot of folks get ready to buy a home, because what happens is you got people that might have some old medical debt, or they've got some old charge-offs, wherever the case may be. And the problem is when that collection, if there's a collection that gets transferred from one collection agency to the other, then all of a sudden it becomes a new current date of last reporting. It becomes like a whole brand new account. So this debt may be 5 years old, but in the eyes of the credit bureau, it looks brand new every time they transfer it from one credit agency to the other, and just hit your credit all over again. And then sometimes when you make payments on these things, so you're like, okay, I'm going to do the right thing and pay down these collections. Well, every time you make a payment, what'll happen is sometimes these collection agencies will then redraw the account to the new balance, and so it looks like a brand new updated reporting again. So it's all about the data last reporting, and so you got to be really careful with that stuff. Sometimes it is the best option to pay those things and pay them off. Sometimes it's not. That's why I lean on these guys for help with that type of guidance. That's over and above my expertise in that arena. Absolutely. What else?
Okay, to ask, I guess, are we focusing only on a specific area of lending, or can I ask a question that's kind of
whatever you want?
Okay, so one thing that came to mind was something you were saying was, for the people who are self-employed, the 1099ers out there, and in today's economy, there are many. I know the golden rule was always that net income was used, right? For the self-employed and the 1099 folks. I'm wondering, is that still the case? Are there any attractive products out there that cater to this kind of ever increasing segment of the population that's not W-2?
Yes, to all of those things. Yes. So for traditional lending, we still are going to look at the net income. So if you're on a Schedule C, we're going to look at line 31. Okay, and that's going to be your net income. And then we can go back and add certain things like depreciation, so on and so forth. But yes, there are programs for folks that are 1099 or self-employed, maybe they have a corporation or whatever, however they have it set up, that allow for a higher utilization of their income outside of the net. So we have bank statement loans that have been popular with self-employed borrowers. Now the trade-off, of course, when you utilize one of these higher risk products is a higher cost. Absolutely. But what we have found is with certain folks that they would rather pay a higher amount on their rate than pay Uncle Sam an additional $100,000 to make their net income look better. So it's really sort of that trade-off there. And some have done that to buy a house, and then refinanced later once they've once they're income has, once they've, had tax return years where the income is, showed a better net income. So, yeah, absolutely. And there are products. I did one recently where with Jill Parker, she's an agent out of the office there. Her borrower was 1099 at a temp agency, and he'd only been there for a short time, but he'd been in the same industry for multiple years. He just happened to be at this temp agency now because his employer had moved him to California. He hated it there. He wanted to move back, and he hadn't found a full-time, role back up here in Oregon. So he was on this with his temp agency that contracted him out to places like Intel and stuff. He was doing the same thing, making good money, had a great down payment, no problem. Typically, for typical lending, if you were going to be a temp, you'd have to show 2 full years of that income. But for him, for this product that we use, we were able to use it right away for it, just the nature of his profile and this. And the rate really wasn't that out of control. I think it was like 5.25%, which sounds high, I guess, in this market, but really wasn't that bad for what he was looking to do. So yeah, so there are options out there, creative options. It really just sort of depends on sort of the whole, the whole profile. But in general, yes, for typical lending, net income and P&Ls. So a lot of people, with COVID this last year, they've really gotten a lot stricter with self-employed borrowers for typical lending, and are requiring P&Ls even with folks that are just 1099 and do Schedule C once a year. They've never done a P&L. They've been 1099 for 20 years now. I ask them for a P&L and they're like, why? I've never had to do this before. I'm like, I know, thank COVID, I guess, but these are some of the new rules. So I've had to Google P&L for people and email them links a couple times. But hey, understandable. They've been operating their business for a long time and never had to do something like that. So, but that's sort of the world we live in right now.
Thank you.
Yeah.
I have kind of backing up a little bit. Would you like us as agents to be telling our clients to make sure they're not getting into debt? I kind of know the answer to the question, but I just want to I want everyone else to hear from a lender about that topic.
Sure. Yeah. So, especially if somebody is, well, here's a question I get a lot of times when I'm talking with people about pre-approval is, how long does my pre-approval good for, right? Like, well, there's a couple of answers to that. First, your credit report is going to be good anywhere from 90 to 120 days, right? And then at that point, your credit report expires and you'd have to update it to renew your pre-approval. But your pre-approval remains sort of intact for as long as your information remains the same. So if I pre-approve you today for a $500,000 loan, and then tomorrow you go and buy a car and get a new $800 a month payment, well, your pre-approval is no good anymore. It's now expired after 1 day because you wouldn't change your information. No big deal. Call me so I can put that information into your profile and we'll just update it. And if you got enough income to cover it, fine, no big deal. If not, then we need to, discuss where, that pre-approval is. So yeah, adding debt when you're trying to buy a house isn't good. Sort of as a general rule. Now, if you're doing it to build your credit, then focus on revolving debt and underutilized revolving debt. With a car payment or another installment loan, you are going to have a fixed payment stuck in your debt to income ratio, regardless of what you do with it. So it doesn't matter what the balance is. Your balance could be 100,000, it could be 10,000, but if your payment is $500 a month, regardless of the balance, we're looking at that $500 a month, not the total balance of the debt. Whereas revolving debt, you can pay that off to a zero, and now we have zero amount that we can use to, to cash flow you on your debt to income. So if somebody needs to build credit, then go ahead and focus in the revolving debt arena. Just make sure it's underutilized. Yeah, you're going to take a, you're going to take a credit hit for it. But if you have to build credit, then you're going to have to do it. So, but as a general rule, yes, adding debt, and that includes being a co-signer. I just co-signed on my kid's FAFSA. He's going to college, and we just took out $20,000-$30,000 worth of student loans for their first year, but they're all deferred. Well, I'm sorry, that now has to be counted into your debt to income ratio. And so those are all things to consider. If you co-signed on an auto loan or a home loan, whatever the case may be for somebody, that's all got to be factored into your debt to income ratio. Now, sometimes you can take that out if you can show that somebody else out of an account that you're not listed on has consistently paid that debt for 12 months on time. Then we can sometimes take out, we can take that out of the debt to income calculation. But if it's a deferred student loan and you're on it, then, and nobody's paying it, then it's going to have to be counted. It's going to have to be counted in. And even though it may show a zero payment, and we have to calculate, typically about a 1% repayment on it. So if it's a $30,000 loan, that's a $300 payment, basically.
Do you have a conversation with buyers about not getting into debt during the transaction?
Yes.
Okay.
Yes. In fact, we provide them a PDF called Do's and Don'ts that we give them at the beginning of the transaction. And on the don'ts is don't run your credit, don't let anybody else run your credit, don't, with the exception of somebody getting home insurance. I know in Oregon they use credit for home insurance, but that's a different type of review, and they don't count that against you. But yes, we had that conversation with folks. I've had people that, I had somebody text me from the car dealership 2 days before closing saying, I want to get this truck. The dealership manager says, don't worry about it. It won't hit my credit for 60 days.
Car dealers, you gotta love them.
Yeah. So, I said, no, don't do it, because what happens is the day of funding, even after somebody has signed, the day of funding, we run what's called fraud guard. And that is basically just a report. It's not a full credit report. It's just an inquiry to see if any new inquiries exist out there. And if they do, then we'll hold up funding that day to find out what that was. And, so we do have that conversation. We always encourage you guys also to have that conversation with them as well.
So when is it absolute? So if you're advising your client, when is it absolutely safe for the guy to go buy his truck?
After the loan is funded and they have and it's recorded with the county. And then at that point, I would say maybe at least wait until the next day.
I don't know if this is still the case. I remember, like, when I bought my first home, this was years ago, that I was advised that sometimes the lender will do a look back even, a few weeks into the loan to see if you've taken on it. But I don't know if that was, maybe that's stale advice now.
They can. It's uncommon. Okay. And at that point, nobody's going to take the loan and home away from you, even if you do. What the look back would do would probably cause more issues for me as a lender than the buyer, because what would happen is that could make the loan unsaleable, meaning
they couldn't offload it to
and maybe difficult for us to offload it onto the secondary market to a different servicer if we choose to. Right now, we service about half of our portfolio, and the other half gets, transferred. Yeah, good question though.
How old does a bankruptcy need to be before you can buy a house?
Oh, good question. Let me pull that up. It's a different answer for different products and different types of bankruptcies. So hold on here. I may even be able to share my screen here on this. So we have some specialty products that allow you to buy 1 day out of bankruptcy. Of course, your rate's going to be really high and you've got to put a lot of money down. But for your typical lending, you've got, here you go. Can I share my screen? Can I?
Austin would have to make that happen.
Hold on, I might be able to do that. Hold on.
No, you're good. It's anyone can.
Okay. All right, can you see that?
No. Now we can.
Now you can? Okay. All right. So here are the different types of, you got your bankruptcy, your Chapter 7, your Chapter 13, and then you've got all these other things, foreclosures, short sales, deed in lieu, so on and so forth. FHA is generally your most accommodating with 2 years on a Chapter 7, and then VA also 2 years, and then Freddie and Fannie 4 years. However, if you have a foreclosure that is included with a bankruptcy, then you often will have a longer waiting period. So you've got 7 years for conventional, 3 years with FHA. So it really just sort of depends there, and we'll look at all circumstances. I recently did a bankruptcy on a Chapter 13 where somebody had just completed their 1 year payout period, and they were able to get into a home. The extenuating circumstances, basically just don't ever think that that's going to get approved. It's super rare that extenuating circumstances are approved. Basically that's when somebody dies, and is about the only time I've ever seen one get approved is when there was a death involved, and then the surviving spouse was able to at that point buy after their 12 months. So it's pretty rare. So that answers that for bankruptcy questions for your typical lending options. What else?
No other questions? I think I had one. Oh, I know I have another one. I have heard that if you have your credit pulled for a mortgage, that you have 30 days to mortgage shop and can have other, I've never done it because I didn't think it was true, but can you mortgage shop and have other people pull your credit during that period of time without dinging your credit?
So yes, you're sort of allowed this flex period to where a new mortgage pull within that sort of 30-day window isn't necessarily going to cause your score to go down further. The caveat to that, and what I tell people is, however, if you have other credit events during that time period, then the new lender that you pull your report with, that report may not be the same as what you just pulled with somebody else. So if on Monday, I pull somebody's credit report, and then on Friday, they pull it with somebody else, they might not get the same results. they may not get a drop in their score from the person on Friday pulling it, but Tuesday, Wednesday, or Thursday, they may have had another credit event that has affected their score to where the new report isn't going to be the same. So if one of their credit cards reported, if they had a collection report, if they had, whatever the case may be, maybe they went and got a new credit card. Who knows? But that result may not end up being the same as what I pulled that day because they had another credit event that affected it in that meantime.
Mm-hmm.
Does that make sense?
Mm-hmm.
Yeah. Okay. Well, I always try to make sure I tell people that when I talk to them about it, because they expect it always to be the same. And then if it's different, they may think it's as a result of the additional credit pull, but more often than not, it's not. It's due to other, credit events that are happening, all the time with people's credit. So yeah, good question though.
So for you new agents, I actually have not had a chance to meet with either you, Keith, or you, Anna. And we will, either me or the new PC. There's a new one coming on, so there'll be two of us are going to meet with you, probably me this week, and then she'll off with you next week. But one of the first things I have you do is reach out to lenders. Josh is on the top of the list for that, so you can get fluent. We did a lot of that today in this meeting, but it's really important to be really fluent in lending so that you can, that's the first thing you direct your client to do, is talk to a lender, get pre-approved. You really can't, you can take them out to look at properties. Some of them won't let you view the home, though, if you don't have a pre-approval. High-end homes typically, and COVID, a lot of them won't let you even in the door without a pre-approval. So that's the first thing your client should be doing. Not to say you don't want to meet somebody that calls you and says, hey, or somebody that comes at an open house that wants to look at a house right after. If you can get in to show the house, take them. But then the next first step, it needs to be, so you're not wasting a ton of your time, them getting pre-approved. That's one of the most important parts of this whole real estate thing.
And that begets a question. Let's assume, obviously a lot of the time in getting the pre-approval has to do with the client providing the documentation, but assuming they have everything in hand, I guess maybe this is for Josh, how long does the pre-approval process take, assuming you have everything you need?
I mean, if I have everything we need, then I can review something within a couple hours.
Okay.
And do it. I did one for Brian.
Wickersham?
Yes, on Sunday. This last Sunday, I talked with the client. They sent me. They completed the application, sent me everything I needed, and I had them pre-approved by it was like 4 o'clock or something. I originally talked to him at noon. He got everything over to me, and they were able to put an offer in that same day. So absolutely, if you got somebody, reach out, let me know. I'm happy to talk them through it and then get their application going, right away. So the biggest part, obviously, sometimes is that data collection, is getting them to get me documentation. We've got some electronic resources that, if people work for certain companies, I can pull their income electronically, and they don't, without them having to send me pay stubs. I mean, eventually they'll have to, but I can sometimes get the pre-approval in place just by that resource. But that's only if their employer is part of like electronic services. And then same thing with like bank accounts. We can send somebody a link and they can basically plug in their banking online information, and then I can see statements that way. So, we can usually do it pretty quick, as long as, like you said, everybody gets over what they need.
Right.
Yeah, absolutely.
Josh is amazing even at weekends. So if you are at an open house, he's a good one to contact to try to get people glued to you too.
Yeah, no, absolutely. Reach out anytime. We try to, give you guys enough information. You don't have to be the expert though, on all the different products. feel free to call me. If somebody's got a specific question right then and there, just call me, and if I can answer, I will, and you can put me on speakerphone. I'm happy to, answer those questions right there. So anytime, absolutely.
Does anybody on a different note, any concerns, because we're kind of getting to the end of our hour, but anything you're struggling with or want to go over? If not struggling with anything, any wins that you want to talk about? I know we had 2 agents that are actually on here right now. Stacy, I think she's on here,
Yeah.
but okay.
I was eating some food, sorry.
One of the agents doesn't have a name on their thing. I actually think it's Anna that doesn't show up on there. Anyway, Stacy and what's the other one? Sherry, both won offers this weekend in multiple offer situations. So that was great. I think they were, I don't remember how many you were. Well, Stacy's wasn't quite a multiple offer. That was just kind of an interesting, it was a possible multiple offer. And the agent was a little bit difficult on that one, but Sherry's was multiple offer situation.
Yeah, we had 7 offers total.
That was great. Cash offer, those always help, but I think you were up against hers too. So if you don't mind talking about what you did to make sure you won that, because I think there were 3 offers total that were, I think you said were all cash.
Yeah. Well, one, I just hounded the listing agent as well. Just for information without being able to, be given direct information. Included a little love letter, with that, because you never know if the emotions are going to be included or not. And I just said, here's what we're going to send you. Do you think it'll do it? And he said no, and gave me decent information to make sure that we came out on top. And of course, they were truly all cash. There was another like 50 to 75% cash, and they of course would love the most uncomplicated one possible.
She had some other features in there, like not asking for repairs under a certain amount. Also,
yeah, we put in after inspection, not to, nickel and dime them up to a cumulative 100. What did we say? 1,500, I think, because they already know they're going to be making some of the changes, and thought if that makes it more attractive, then perfect.
I think a lot of what helped too was the communication with the agent, because if you would have just submitted your offer and sat back and hoped for the best and kept your fingers crossed, they would have picked another offer.
Because 100%. We would have missed it by $5,000. Yeah, is really what it came down to.
So that's super important. And then Stacy's was a little bit different, but she also won the offer. That one was a little nerve-wracking because it took a couple extra days of waiting.
Congratulations.
Could have just taken the offer from the start. She had a really good offer. Hers was almost all cash too, so that's good.
Yes, 300,000 down payment.
Those always help.
Yes, yeah. But we only had to go 10,000 over asking.
So that's not bad. Yeah, I've seen some really high ones lately. Some agents that I've talked to this week that said that they were, I think somebody told me $699 and it went for $805. You typically don't know those numbers ahead of time though. I mean, agents really shouldn't be talking about numbers and telling you where it actually landed in the end until it closes, because if it sale fails, now you know what those numbers are, and they shouldn't be coming out, but every agent will give you a little bit more information. So communication is pretty key.
Well, one of the houses that she was going to put an offer in, they ended up closing at 75,000 over asking, which is just ridiculous. I told her to pass. I told her, don't even bother.
Ryan Purdy had his own listing, went for an insane amount over asking. I think it just closed. Well, that was the other one. He's had a few closings, or a couple of closings already, and a few coming. But his listing, I want to say, are you still there, Ryan?
Yeah, I'm still here. It went 80K over asking
80.
for a $520,000 listing.
And then your $1 million one went for,
oh, that was 170K over.
170K over. So kind of crazy out there. Much better to have listings right now than buyers. But we are winning some offers, so just being creative and keeping in touch. And Having good lenders makes a big difference, because if you have a lender that, I keep pushing lending, but that's such a key part. That's 50% of the deal in a lot of cases, not every case, but having a lender that will talk to the other side too, to plead your case and say, no, they're really qualified, will help you win. Knowing your loan products. If you have a USDA buyer and you're up against a conventional, they're probably going to pick the conventional, but there are some ways to try to make yourself more appealing, even though you have the weaker kind of offer.
Can you provide some of those suggestions?
Keeping in touch, what Sherry did, that was really key, so that you can up your offer. You have appraisal issues sometimes, especially in those lower price ranges. So if you do have a USDA loan, you have a lot stacked against you. You're in a lower price range, you have a lot more competition. You're probably up against more cash buyers, and those are going to win over a USDA they're just harder loan to get through. Typically USDA and oftentimes VA, they have no down payment. And so you have no room. You have a buyer that doesn't have any extra money to make up an appraisal gap. But you could do things like writing the love letter, trying to appeal to the homeowner that way. Be really careful with the fair housing laws, though, in that case, more so on the listing side than the buying side. If you're on the buy side, it's kind of, you can do whatever you can possibly do to plead your case. From our lender's amazing. He always gets everything done. Go ahead and call him and he'll tell you all about it. To we won't ask for any repairs that are not lender required. But don't take your contingency away. If you take your contingency away and then the buyer finds out there's an appraisal problem and the seller's not willing to fix it, and the buyer backs out, but the contingency's gone, they won't take their earnest money with them. So keep that in mind. Leave that contingency there, but just say you won't ask for repairs, but you still have your out on that one. And the seller would say, okay, well, I don't have to do anything to this house, so maybe I like that offer a little bit better. Call the agent ahead of time too, and just say, what's going to be the most appealing thing to your client? Is it price? Oftentimes it is, but sometimes it's not. Sometimes it's they want another family to raise their family in the house that they raised their kids in, or to take care of the house the way that they did. So lots of little things like that. But I think the biggest thing, communication, really, between you and the agent, and communication all the way to the end. Don't just send your offer over. Also, wait till the last minute. One of the key things that I do is put my offer in last, because if you notice, some agents are more of a blabby mouth than others, and they're working the offers against each other. So if you put your really great offer in right up front, you're leaving room for that agent to leverage that one against other offers. So I like to be the last offer in, and I'll even tell the agent that I want to be the last offer in. So let me know if you're going to review early. Keep in touch with the agent without pestering them to death, and then put it in last minute so that you're less room for them to leverage against you.
And
Their
Chantel
transaction coordinator for mine told me that the buyer was highly, highly motivated. Oops.
Whoops.
Yeah.
I was just going to say, Chantel, what you just said is exactly what I said to, the listing agent as well. And, he was fairly excited to get to work with me because we were in it to win it. And so it was great advice.
So I'm gonna contradict just a little bit, because I just had the exact opposite happen for me, where we were waiting for last minute, and then I told the agent we're gonna place an offer, and the other agent put it pending. And I called her and I said, "What's going on?" She goes, "Well, we just had such a good offer that the seller just wanted it right then." So I think we got to read the tea leaves sometimes in those situations, especially with what's happening.
Oh, that's frustrating. I have seen that happen a time or two. It's not in the best interest of their client to do that, but they do have to listen to their seller at the same time, because they could leverage more offers. They could get better offers. And if they know one is coming, it's crazy to not wait for it. So that's frustrating. How much did you keep in touch with the agent through the whole thing? Like, how much of a gap was it between we're writing the offer and when you found out it went pending?
It was consistently. So as soon as they listed it, we talked to them. We were about to go see it. We didn't even see it. We saw the virtual tour, and they did go see it. Said we were going to write an offer right after it, and they just went silent. So tried calling, tried texting, nothing, and then all of a sudden it went pending. So
So you may not have had time, even if you had written your offer right away.
Yep, may not.
In that case, they may have been overwhelmed too with the market, with how many showings they were getting, and the seller might have just been on overload and said, just sign something. I don't
It's
want
possible. It was underpriced. So
Yeah, that's frustrating when agents do that too. So on that topic, this is kind of a weird market because things fly off the market. So the agents who are underpricing property to try to get these bidding wars going are not doing their people very good favors, because one, they're getting, I saw something over the weekend on one of our agents posted it. I can't remember who it was, but I read it this morning, about like 77 offers and 85 offers on a property. That's overwhelming to a seller to have to look at all of that, also to the listing agent. So if you're underpricing a property and you're getting that many offers, that's not doing them any favors. It's also probably not getting the price where it needs to be, versus putting it right in the middle where it does need to be. You're probably going to drive the price up over. And then the worst thing you can do is overprice a property. So when you have a seller that comes in and says, oh, I know I can get $800,000 for my house, but the market is saying $750, they probably can get $850 for it. But if they price it at, or $800, price it at $800, they're not probably going to get $800, because you'll have to come back. You're going to chase the market back downhill. If you're not going to have enough offers to leverage against each other to drive it up that high, if that makes sense. That's kind of on a whole different topic, but there are several of you that are getting listings. So that's good to know that information also. And that's just my opinion. Everybody's got a different opinion. I do see agents who undercut. I know a few of them who consistently put houses on the market under value, and then that's frustrating for us as agents also, because our buyers think they can get it at that price and they can't. Anything else that anybody wants to go over? Any other struggles?
Too early to say yet for me.
Yeah. Yeah.
I'll know soon enough.
Yep. We need to get you on some opens, so we'll have to meet this week. So I'll reach out to both you and Anna a little later today and get something going. So actually, are you going to do commercial too, Keith, or are you just going to do residential only?
I am. I'll have to figure out how to navigate.
Mm-hmm.
But yes, my plan at this point is to try to move on two fronts.
So if anybody needs referrals for commercial, we have another commercial agent. He's going residential now, but if Stacy also has passed commercial, she were to residential also. So a couple of people that way. But.
Excellent.
So I guess we're a little over on time, but nice to see everybody. Thanks for coming also. And
thank you, Chantel and Josh.
Thanks for having me.
Thank you, Josh. That was incredibly cool.
Yes,
Hey,
thank
Josh,
you.
really quick, this is Sherry. The forms you had up when you shared your screen with the deadlines or something like that. Do you know what I'm talking about?
Yeah.
Is there a way we could access that?
Sure. I could send you a copy of that.
I caught it toward the end, and I thought that would be helpful for me.
Yeah, no, absolutely. I could put
Okay,
something
thank
together.
you.
You
Any
bet.
information, Josh, that you can dump on us would be great.
I will. Okay. Thanks, guys.
Okay. Thank you. See you guys all later.
Thanks, Chantel.
Thank you.